The more you try to force outcomes, the more the market resists you. The moment you feel the urge to make something happen, you disconnect from objectivity and step into a world driven by fear, hope, and illusion. The market was never designed to give you what you want just because you want it. It was designed to express its own movement, its own structure, its own flow. Your job is not to control that flow. Your job is to synchronize with it. Forcing trades is nothing more than an emotional response to discomfort. It's the urge to escape uncertainty by creating action. You tell yourself you're doing something, but psychologically, what you're really doing is avoiding the feeling of not knowing. The problem is that the market doesn't care about your discomfort. It cares only about behavior aligned with probability. When you act from emotion instead of alignment, you act outside your edge, and the market has only one way to correct that mistake: by taking your money. The traders who succeed are not those who are constantly in the market. They are the ones who wait, with patience so disciplined it almost feels unnatural. They understand that waiting is not a passive act. It's an active engagement with the reality of uncertainty. It takes mental strength to sit with the fact that the market owes you nothing. It takes emotional maturity to accept that no trade is better than the wrong trade. It takes psychological mastery to wait for the trade that aligns with your rules, your edge, and your belief system. True consistency doesn't come from frequency, it comes from selectivity. Every trade you take carries a cost, not just in risk, but in emotional capital. When you force trades, you drain that capital, making it harder to see clearly, harder to execute objectively, and harder to remain confident. But when you wait, when you sit with discipline and neutrality, you protect your clarity, your confidence, and your ability to act without hesitation when the market finally presents the right opportunity. There is immense power in doing nothing, because nothing is not empty. Nothing is the space where your edge lives. Your edge is not a signal, not an indicator, not a pattern. Your edge is the mindset that allows you to wait for the alignment between your plan and the market's movement. That alignment is where probabilities tip in your favor. That alignment is where consistency is formed. That alignment is where real traders separate themselves from emotional gamblers. Every moment you wait is a moment you strengthen your psychological foundation. Every moment you resist the urge to force action, you train yourself to think in probabilities. You learn that your success comes not from chasing the market, but from allowing it to come to you. And when it does, you execute effortlessly, because your mind is clear, your emotions are balanced, and your beliefs are aligned. The market doesn't reward urgency, it rewards discipline. Your real edge is not in predicting what will happen, but in waiting for the moment when the odds genuinely favor you. Master that, and you master yourself. And when you master yourself, consistency becomes not an aspiration, but a natural consequence of how you engage with the markets. Forcing trades is a psychological impulse rooted in the fear of missing out, not an objective market information. It is the moment when your internal need for action becomes stronger than your commitment to clarity. When this happens, the market stops being a neutral environment of opportunity and instead becomes a stage where your fears, hopes, and unresolved expectations play themselves out. Most traders think they are dealing with charts, candles, and price movements, but what they are really interacting with is their own belief system, filtered through the lens of fear of missing out. This fear creates an illusion of necessity, an artificially heightened sense of urgency that has nothing to do with whether the market is offering a legitimate edge. It is a psychological trick, and if you don't understand it deeply, it will dominate every decision you make. The urge to force a trade rarely shows up as a clean, obvious emotion. It disguises itself as logic. It whispers ideas like this might be the start of a move, or I don't want to be late, or even if it's not perfect, it could still work. This is not analysis. It is emotional justification. Fear doesn't announce itself as fear, it disguises itself as opportunity. And because the markets offer limitless potential, your mind can always find a way to rationalize, taking a trade that violates your rules. The moment you begin to rationalize, the battle is already lost. You have transitioned from trading your edge to trading your emotions. Objective market information is neutral. It has no agenda. It does not care whether you participate or not. Price will move with or without you, profitably or unprofitably, regardless of your involvement. But fear of missing out convinces you that your absence from the next potential move is a mistake. You begin to interpret every price fluctuation as a signal, not because it meets your criteria, but because your mind cannot tolerate the discomfort of watching the market move without you. This emotional discomfort is the engine behind forced trades. It is the subconscious belief that being inactive is dangerous, that waiting is losing, that patience is a threat rather than a strength. In reality, this belief system is built on a fundamental misunderstanding of trading. The market offers endless opportunities. There is no single trade that will determine your long-term success. There is no one big move that you must catch to become consistent. Consistency is built on a series of high-quality, rule-based trades executed over time, not on frantic attempts to participate in every fluctuation. But fear of missing out distorts this truth. It makes the market appear as if every candle is going to run without you, as if every move you skip is a personal failure, as if you are falling behind simply because you are not active. This distortion pulls you away from your edge and into a psychological cycle of chasing. Forcing trades is not a technical problem, it is an emotional one. You cannot solve it by adding indicators, scanning more charts, or creating more complex setups. You solve it by understanding the psychological mechanisms that create the urge to act prematurely. At its core, forcing trades comes from the belief that action equals progress. In normal life, this belief is often true. In careers, relationships, and daily tasks, doing something feels productive. But trading operates on an entirely different psychological framework. In the markets, doing nothing is often the most productive thing you can do. Waiting is not passive. Waiting is an active discipline that protects your capital, preserves your clarity, and enhances your ability to act decisively when the right moment finally appears. When you force a trade, you abandon that discipline. You step out of alignment with your rules and begin reacting to the market instead of interacting with it. Reactivity is the state where your emotions dictate your actions. Interaction is the state where your system and belief structure guide your decisions. The difference between the two is the difference between randomness and consistency. When you act from fear of missing out, your trading becomes random. Even if a forced trade results in a profit, it is a dangerous reinforcement of a destructive habit. You are rewarded for breaking your own rules. And the next time the market moves without you, the fear becomes stronger, and the impulse to act becomes even more compelling. The emotional cost of forced trading goes far beyond a single loss. It erodes your confidence. It creates doubt. It fractures your relationship with your own strategy. When you take trades for emotional reasons and they fail, as they often do, you blame your system, not your lack of discipline. You start tweaking rules that never needed to be changed. You redesign setups that were perfectly valid. You transform a psychological issue into a technical chase, constantly searching for a system that eliminates discomfort rather than learning to manage it. But no system, no indicator, no strategy will ever remove the emotional tension of uncertainty. The markets are built on uncertainty. The only thing you truly control is how you respond to it. Fear of missing out creates the illusion that you must participate to survive. But the deeper truth is that your survival as a trader depends on your ability to not participate when the market is not offering your edge. Every professional trader understands this. They know that the real danger is not missing a move, it is losing discipline. Missing a trade costs you nothing. Losing discipline costs you everything. Discipline is the thin psychological line that separates consistent traders from emotional actors, and forcing trades is the slow erosion of that discipline. The market does not punish you for missing opportunities. It punishes you for acting without alignment. When you take trades that do not meet your criteria, you are acting from a place of emotional need. That need overrides patience, clarity, and objectivity. And the market has a brutal way of exposing misalignment. It shows you through loss or emotional exhaustion that your behavior was not rooted in probability, but in impulse. The more you force trades, the more unpredictable your results become. You lose trust in your system, trust in the market, and eventually trust in yourself. But when you understand the psychological root of forcing trades, you reclaim control. You begin to see that the fear of missing out is nothing more than a conditioned response, a habit formed by emotional pressure, not by market reality. You learn to recognize that being flat is a position, waiting is a position, observation is a position, and these positions often carry more power than any impulsive entry ever could. They allow you to protect your capital so that when the real opportunity appears, When the market is aligned with your rules and your beliefs, you can execute without hesitation, without distortion, and without emotional conflict. True freedom in trading comes from releasing the need to be constantly involved. Freedom comes from the realization that opportunities are endless, but your capital is not. Freedom comes from understanding that you do not need to catch every move. You only need to catch the right ones. And the right ones only become visible when you are calm enough, disciplined enough, and objective enough to wait for them. When you stop forcing trades, you reconnect with your edge. You start seeing the market as it is, not as your fears interpret it. You begin to think in probabilities instead of predictions. You allow the market to tell you when to act instead of imposing your emotional impulses onto it. And when that alignment happens, trading becomes fluid, consistent, and psychologically sustainable. Your real edge comes from waiting for the market to show clear alignment with your predefined beliefs, rules, and risk parameters. This truth is so simple, yet most traders never live it. They hear it, they nod at it, they intellectually accept it. But when the market begins to move, when candles start forming rapidly, when volatility kicks up, or when boredom stretches out over hours, their discipline dissolves and their impulses take over. The mind begins to fabricate opportunity where none exists. The trader starts trading the movement they wish existed, not the one that objectively aligns with their plan. And in that moment, they abandon their edge entirely. Your edge is not the setup you see on the chart. It is not a pattern, an indicator, or signal. Your edge is the disciplined state of mind that allows you to interact with the market objectively. Without that mindset, even the best setup becomes meaningless. Without psychological alignment, no technical alignment matters. Trading is not about forcing your will onto the market. It is about recognizing the specific conditions in which the probability shifts ever so slightly in your favor, and then acting only when those conditions are present. Anything else is emotional trading. Random action wrapped in the illusion of logic. To wait for alignment means you have accepted uncertainty. It means you understand that the market does not move according to your wants, fears, or expectations. Alignment is not something you create, it is something you observe. It is an intersection between what the market is offering and what your rules define as opportunity. Too many traders try to impose their beliefs onto the market and expect the market to conform to them. But the market is not a canvas for your psychological projections. It is a neutral environment. Your beliefs only matter when the market's behavior confirms them. Until that confirmation appears, you have nothing. And the strength of a professional trader lies in their ability to recognize nothing and accept it. Most traders cannot accept nothing. They feel incomplete when they are not in a trade. They confuse activity with progress. They think that being in the market means they're getting closer to their goals. But trading is not about motion. It is about alignment. It is about waiting for a moment when your system, your psychology, and the market converge. That convergence is rare. That rarity is what gives it value. The edge does not exist in every minute, every candle, or every fluctuation. It exists only in specific conditions. And your job is to stay neutral until those conditions appear. Waiting for alignment is not easy because it requires confronting your psychological discomfort with uncertainty. Uncertainty is the natural state of the market. But for many traders, uncertainty feels like a threat. They want assurance. They want confirmation. They want the illusion of control. So they take trades prematurely, hoping the market will align after they enter. This is the exact opposite of trading with an edge. You cannot enter a trade and then hope alignment forms around you. The alignment must be present before the commitment. If it is not, you are gambling emotionally, not trading probabilistically. Your predefined beliefs, rules, and risk parameters exist to protect you from your own impulses. They are not constraints, they are freedom. They free you from the emotional chaos of the moment. They free you from overthinking. They free you from doubt. When you wait for the market to align with your rules, you remove the need to predict. You simply observe. You wait. And when everything lines up, your action becomes effortless because you are acting from certainty, not certainty in the outcome, but certainty in the process. That is the only real certainty a trader can ever have. Think deeply about what predefined beliefs truly mean. They are not just ideas you read in a book or strategies you copy from someone else. They are the internalized principles that guide your understanding of the market. They are your framework for interpreting behavior. When the market aligns with those beliefs, you feel clarity. When it does not, you feel conflict. Many traders ignore that conflict. They push through it because they want to participate. But that psychological tension is your mind trying to protect you. It is a signal that conditions do not match your edge. When you ignore that inner signal, you disconnect from the very structure that makes consistent trading possible. Rules exist because the human mind cannot remain neutral under pressure. Without rules, the mind will always revert to emotional reasoning. It will always find a way to justify action, especially when money is at stake. Rules prevent you from drifting into chaos. They filter out the noise and leave only the opportunities that align with your system. But rules are only useful if you respect them. A rule ignored is not a rule, it is a suggestion. And suggestions carry no psychological weight. Rules are there to be followed, not debated in the heat of the moment. Risk parameters are where most traders completely lose their edge. They think risk management is about limiting loss, but that is only half the truth. Risk parameters are also a psychological anchor. They create boundaries that define when you are operating within your edge. If a trade does not fit within your risk parameters, it is not aligned with your system. No exceptions. The moment you adjust your risk just this once, you fragment your discipline. Consistency collapses when you start making exceptions, because exceptions are emotional decisions disguised as temporary flexibility. But in trading, temporary weaknesses become permanent habits if they are rewarded even once. Waiting for alignment is the ultimate form of trading discipline. It is the willingness to prioritize long-term consistency over short-term excitement. It is the ability to endure boredom, uncertainty, and the pressure of potential opportunity without breaking your rules. Most traders do not fail because their strategy is flawed. They fail because they cannot wait. They cannot hold still. They cannot tolerate the mental tension of watching the market move while they remain flat. But true professionals understand that staying flat is a position. It is a deliberate choice that protects their capital and preserves their psychological clarity. Patience is not passive. Patience is active mental discipline. Patience is choosing objectivity over impulse. Patience is the recognition that the market will eventually align with your rules, and when it does, you will have no doubt. There will be no hesitation because you waited for a moment that resonates with your system. And when that moment appears, you do not need excitement, you need clarity. Excitement is the emotional state of a gambler. Clarity is the mental state of a professional. You do not have to guess when alignment is present. You feel it, you see it. It makes sense to you. It fits your rules without force. It fits your beliefs without conflict. It fits your risk parameters without compromise. That is the kind of trade that forms the foundation of consistency, not the forced trades, not the emotional trades, not the impulsive entries driven by boredom, fear, or urgency, only the trades that align. Those are the trades that produce long-term results. Your edge does not come from knowing what will happen next. It comes from knowing when the environment is suitable for action and when it is not. Most traders try to guess the future. Professionals evaluate conditions. They wait for confirmation. They wait for clarity. They wait for alignment. And they understand that waiting is not wasted time. Waiting is preparation. Waiting is refinement. Waiting is what allows them to strike decisively when the opportunity finally appears. The market rewards alignment, not action. The market rewards discipline, not urgency. The market rewards those who can wait, not those who chase. Your real edge is not speed, aggressiveness, or prediction. Your real edge is your ability to wait until the market and your system speak the same language. When that happens, trading becomes fluid, objective, and consistently profitable. Patience is not passive, it's an active psychological discipline that protects your capital, your confidence, and your ability to think in probabilities. Most traders misunderstand patience. They think it means sitting back, doing nothing, waiting lazily for something to happen. They view patience as inactivity, as if it's simply the absence of action. But in trading, patience is not what happens when you do nothing. Patience is what happens inside you while you wait. It is the mental posture you hold, the belief system you reinforce, the emotional state you maintain, and the clarity you preserve while the market unfolds moment by moment. Patience is the invisible architecture of consistent trading, and without it, nothing else you do will matter. The essence of patience lies in your ability to remain psychologically neutral while uncertainty persists. And uncertainty is not the exception in the market, it is the constant. Every moment you engage with the market, you are confronted with infinite possibilities. Price could explode upward, collapse downward, or drift aimlessly. You can't control it, predict it, or force it. Because of this, the emotional pressure to do something becomes overwhelming for many traders. They feel the discomfort of not knowing, and instead of allowing that discomfort to exist, they try to escape it through action. Impulsive trades, chasing moves, early entries, revenge trades, these all come from impatience, which is nothing more than the mind trying to relieve itself from the pressure of uncertainty. Patience, on the other hand, is the discipline to remain emotionally grounded in the presence of that pressure. It is the choice to allow uncertainty to exist without needing to respond to it immediately. It is the ability to observe the market without personalizing its movements. It is the capacity to say, I will wait until the market presents the conditions that align with my edge, even when every part of you wants to jump in. This is not passive. This is psychological strength in its purest form. Capital protection is the most obvious benefit of patience. When you wait for conditions that align with your rules and beliefs, you naturally avoid low-quality setups, emotional impulses, and random trades. Every trade you don't take is just as valuable as the trades you do take, because every avoided mistake preserves your financial resources. Traders lose more money from impatience than from bad analysis. It's not the strategy that destroys accounts. It's the compulsion to act outside the strategy. Patience protects your capital by limiting your exposure only to conditions that give you a measurable advantage. You're not avoiding risk, you're controlling it. You're not hiding from opportunity, you're filtering for only the ones that matter. But the protection of confidence is far more important than the protection of capital. Money can be replenished. Confidence, once shaken, is incredibly difficult to rebuild. Every impulsive trade that ends badly chips away at your self-belief. Every time you break your rules, you reinforce the idea that you cannot trust yourself. That fracture spreads into every future decision. You hesitate when you should act, you act when you should wait, you doubt your system, you doubt the market, and eventually, you doubt your entire ability to trade. This psychological instability is fatal for traders, but patience prevents this collapse. Patience reinforces integrity. When you wait for your setups, you demonstrate to yourself that you are in control of your behavior. You build trust in your ability to follow your rules. You strengthen the internal identity of a disciplined trader. Confidence grows not from winning trades, but from consistent discipline, and patience is the foundation of consistent discipline. Thinking in probabilities is impossible without patience. The moment you become impatient, you abandon probabilistic thinking and fall into emotional thinking. You begin to trade based on what you want to happen, what you hope will happen, or what you fear might happen. Probabilities disappear when emotions take over. Probabilistic thinking requires psychological neutrality, and neutrality requires patience. You cannot think clearly if you are rushing. You cannot evaluate objectively if your emotions are screaming for action. You cannot measure risk accurately if you are driven by fear of missing out. Patience slows your internal pace so your mind can process information without distortion. It gives you the mental space to evaluate the environment, compare it to your rules, and determine whether the conditions are favorable. It allows you to wait for confirmation instead of prediction. It allows you to let the market prove itself instead of forcing meaning onto it. Patience is the discipline that keeps your trading aligned with probabilities rather than possibilities. Possibilities are infinite, emotional, and seductive. Probabilities are selective, structured, and grounded in your edge. When you are patient, you focus only on the probabilities that match your system. When you are impatient, you chase possibilities that have no statistical foundation. Possibilities create chaos. Probabilities create consistency, and patience is the gatekeeper that separates the two. The greatest challenge of patience is that it requires sitting with emotional discomfort. Waiting feels like losing. It feels like being left behind. It feels like you're not doing enough. These feelings are illusions created by your mind's need for certainty. The human brain was not designed for probabilistic environments. It was designed for survival environments, where immediate action often meant safety. But in trading, immediate action often means danger. The instincts that protected you in the real world betray you in the markets. Patience is the process of retraining those instincts. It is the process of teaching your mind that waiting is safe, that stillness is productive, that restraint is strength. This psychological reconditioning is not easy, but it is essential. Patience also protects you from the emotional exhaustion that destroys traders. Trading is not just a financial game, it is an emotional one. Every impulsive trade drains your emotional energy. Every moment you spend chasing the market burns mental fuel. Every emotional reaction leaves you more vulnerable to the next one. When you practice patience, you conserve emotional capital. You remain grounded, composed, and clear. This emotional clarity allows you to perform at your highest level when the real opportunity appears. The right trade does not require emotional energy. It requires psychological precision. Patience preserves that precision. One of the greatest misconceptions in trading is the belief that more trades lead to more profit. This is the mindset of an impatient trader. Professionals know the truth. Fewer, higher quality trades produce consistency. They understand that trading is not about participation, it's about alignment. They know that every trade carries psychological weight, and unnecessary trades carry unnecessary weight. Patience ensures that you only engage when your edge is present. This reduces mental noise, eliminates confusion, and reinforces clarity. Patience creates space between stimulus and response. The market gives you the stimulus: price movement, volatility, speed, hesitation, breakouts, retracements, but your response must be measured, disciplined, and grounded in your rules. Without patience, your responses become immediate reactions. Without patience, you lose control. With patience, you create the internal distance necessary to evaluate the situation objectively. That distance, those few seconds of psychological breathing room, is the difference between impulsive trading and consistent trading. Patience is also the antidote to overtrading. Overtrading is not caused by opportunity, it is caused by emotional discomfort. Traders overtrade because they cannot tolerate the psychological emptiness that comes from being flat. They overtrade because they want to feel active, involved, or in control. But control does not come from action, it comes from discipline. Patience eliminates the emotional pressure to trade simply because the market is open. It frees you from the need to force outcomes. It allows you to sit with the quiet, to sit with the stillness, to sit with the waiting, because you understand that waiting is not wasted time. Waiting is preparation. Waiting is sharpening the blade. Waiting is aligning your mind with your edge. In the end, patience is the psychological environment in which consistency is born. Without patience, there is no edge. Without patience, there is no discipline. Without patience, there is no clarity, no confidence, no probability-based thinking. Patience is not the absence of action. It is the foundation that makes the right actions possible. It is the space where your mind stays aligned, your emotions stay balanced, and your decisions stay objective. It protects your capital, your confidence, and your ability to operate as a professional trader. Patience is not passive. Patience is power. Patience is control. Patience is the true skill that separates consistent traders from emotional ones. When you master patience, you master yourself. And when you master yourself, the market can no longer control you, because your decisions are no longer reactions, but deliberate, disciplined, probability-based expressions of your edge. In the end, trading mastery is never built on speed, urgency, or constant activity. It's built on disciplined waiting. When you protect your capital, safeguard your confidence, and think in probabilities, you operate from clarity instead of impulse. Patience is not something you practice once. It is the psychological foundation you return to every time you face uncertainty. The traders who win are not the ones who chase opportunities. They are the ones who wait for alignment, act without hesitation, and trust their process completely. When patience becomes your default state, consistency becomes inevitable, and the market finally becomes a place you can thrive.